Hello everyone. Welcome to the Stock Minds web channel. Dave, NASDAQ Dave, has quickly emerged as one of the most impressive performers in the fintech space, delivering a rare combination of rapid growth, expanding profitability, and improving cash flow. Its Q3 2025 earnings underscored just how far the company has come, with results that significantly exceeded expectations and signaled a business gaining scale and efficiency. Dave stands out as a compelling story, as one where strong fundamentals, accelerating operational momentum, and still reasonable valuation metrics come together to create a potentially attractive long-term opportunity. In this video, we will dive into Dave's recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About Dave. Dave is a US-based fintech company offering neobank services such as digital banking, short-term liquidity advances, budgeting tools, and side gig job matching. Headquartered in Los Angeles, it serves millions of users through products like Extra Cash, demand deposit accounts, and financial management tools. Founded around 2015, Dave went public in 2022 via a SPAC merger valued near $4 billion. Its mission is to provide affordable, accessible financial services for consumers underserved by traditional banking institutions. Dave Financial Performance. Dave's Q3 2025 financial performance showcased exceptional growth across all major metrics. Revenue for the quarter reached $150.73 million, up sharply from $92.49 million in Q3 2024, a 62.97% increase. Quarterly EPS also surged significantly to $6.34 compared to just 3 cents a year earlier. On a trailing 12-month basis, revenue rose to $491.3 million from $319.36 million, reflecting 53.84% growth, while EPS TTM climbed to $10.12 from $3.12, a 224.46% increase. Free cash flow per share, TTM, strengthened significantly to $16.42, up from $7.48, marking 119.52% growth. Profitability metrics remained robust, with a gross profit margin of 71.57%, net profit margin of 29.87%, and free cash flow margin of 48.48%. Returns were equally impressive, as return on assets reached 25.36% and return on equity hit 65.63%, supported by a conservative 0.26 debt-to-equity ratio. Over the past 5 years, Dave has grown its revenue at a 34.1% CAGR, while net income and free cash flow have also turned positive with high margins and continue to grow, which is an incredible feat by Dave's management. Dave Fiscal 2025 Financial Forecast. Looking ahead, analysts forecast 2025 revenue of $537.16 million, a projected 54.76% increase over 2024's $347.1 million, and expect EPS to rise to $10.95, up 161.42% from $4.19 in 2024. Wall Street analyst remains bullish, assigning a strong buy rating with an average price target of $306.38, implying 45.69% upside, while the highest target of $347 suggests potential upside of 64.99%. Dave's stock price performance and valuation. At the time this video was created, Dave's stock was trading at $210.30 per share. Dave's stock performance over the past year has been outstanding, with the share gaining 146.7%, far outpacing the 12.9% increase of the S&P 500 during the same period. However, since IPO in January 2022, the stock is up only 7.9%, underperformed the S&P 500's 45.2% gain, reflecting its earlier struggles before the recent turnaround. Despite the strong rally, Dave's valuation remains attractive, supported by a price-to-sales PS ratio TTM of 5.65, forward PS of 5.29, price-to-earnings PE TTM of 20.78, forward PE of 19.2, and a compelling price-to-free cash flow PFCF TTM of 11.92. These multiples are relatively undervalued for a company delivering rapid revenue growth, expanding profitability, and robust free cash flow, With improving margins and rising earnings power, the stock still offers appealing value, suggesting that Dave remains a promising investment opportunity even after its significant share price appreciation. Dave growth potential. Dave growth prospect remains solid, driven by several factors. 1. Superior customer acquisition economics and market opportunity. Dave's customer acquisition model represents a fundamental competitive advantage over traditional banking institutions. The company achieves a customer acquisition cost of approximately $19 per customer, representing an 82% cost reduction compared to traditional banks' $100 plus acquisition costs. Furthermore, Dave's cost to serve customers stands at just $54 annually, compared to $300 for legacy banks, a 96% efficiency advantage. During Q3 2025, Dave acquired 843,000 new members while maintaining these favorable unit economics, demonstrating scalability at volume. The addressable market for Dave services has expanded to approximately 185 million Americans living paycheck to paycheck, growing from 176 million in 2022 and representing an increase of 20 million potential customers since 2021. This expanding total addressable market, combined with Dave's efficient acquisition machinery, creates a multi-year runway for customer growth that significantly outpaces the company's ability to saturate its target demographic. 2. Rapid RPU expansion and monetization improvements. Dave's annualized revenue per monthly transacting member, ARPU, increased to $217 in Q3 2025 from $156 in Q3 2024, representing a 39% year-over-year improvement. This metric reflects the company's success in both acquiring higher-value customers and deepening monetization of its existing user base through better product pricing and usage. ExtraCash average loan size grew from $172 to $207, while the gross monetization rate per transaction increased from 5.7% to 6.4%. As a result, average revenue per ExtraCash transaction, gross, climbed from $9.70 to $13.20, representing a 36% improvement in the core unit economics of Dave's flagship product. The company's revised fee structure, implemented in early 2025, has proven successful in capturing more value from high-frequency users while maintaining broad access to ExtraCash for its target demographic. Monthly transacting members grew 17% year-over-year to 2.77 million, demonstrating that monetization improvements are not driving customer churn. This combination of user growth and per-user monetization expansion creates a compounding growth dynamic where Dave's revenue acceleration should outpace customer acquisition growth. 3. Raised guidance reflecting management confidence and product roadmap expansion. Dave raised its full-year 2025 revenue guidance to between $544 to $547 million, up from previous guidance of $505 to $515 million, representing midpoint growth of 57 to 58% year-over-year. Adjusted EBITDA guidance increased to between $215 to $218 million, from $180 to $190 million previously, representing 149 to 152% year-over-year growth. These substantial upward revisions, made following a strong Q3 performance, reflect management's confidence in both continued execution and the macroeconomic environment supporting demand for Dave's services. Notably, the company is building additional revenue drivers beyond its core ExtraCash product, with a Buy Now Pay Later (BNPL) product expected to launch in Q1 2026. This product expansion, combined with the Dave debit card, which saw 25% growth in spend during Q3 to $510 million, provides multiple monetization vectors and reduces dependence on any single product line. The BNPL launch comes at an opportune time as the category matures and consumer credit demand remains resilient, allowing Dave to leverage its customer relationships and underwriting capabilities into a higher-margin product category with significant TAM expansion potential. Risks to consider. While Dave's stock looks attractive, we should be mindful of potential risks. 1. Credit risk. Dave faces exposure to borrower defaults, which can cause revenue losses and necessitate increased loan loss provisions. In Q1 2025, bad loan provisions rose by 7% year-on-year to $10.6 million, reflecting risks in lending activities, especially in consumer loans and some concentrations in commercial real estate-backed loans. Despite this, Dave managed improved loan quality with a lower delinquency rate during the quarter, highlighting ongoing credit risk challenges in its portfolio. 2. Regulatory risks. Ongoing and potential future regulatory scrutiny poses a critical threat to Dave's business model. The Consumer Financial Protection Bureau, CFPB, has proposed rules that could redefine paycheck advance products as consumer loans, severely impacting revenue from these advances. Additionally, regulatory actions and legal proceedings, such as lawsuits from the Department of Justice, increase uncertainty about the company's ability to operate without significant compliance costs or restrictions. 3. Industry competition and innovation. Dave competes in a highly crowded fintech sector filled with established firms and startups, with key competitors like SoFi Technologies, Chime, and MoneyLion, which requiring relentless innovation to maintain its market position. Failure to sustain technological advances and product development risks stunting growth and losing market share. Additionally, Dave relies heavily on a single banking partner, creating operational risk if that partnership deteriorates. Conclusion. Dave's rapid growth, strengthening profitability, and solid cash flow generation position the company as a standout opportunity in the fintech space. Its strong Q3 2025 results, improving margins, and upbeat analyst forecasts underscore a business gaining momentum, while valuation levels remain reasonable despite the stock's sharp rise. Although risks exist, the company's expanding market, scalable model, and rising earnings potential support a positive, long-term outlook. Overall, Dave appears well-positioned for continued growth and remains an attractive investment candidate. But remember, this is not a financial advice. What do you think about Dave? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching and see you in the next one.